So in this video, we're going to be talking about a stock, JD.com. It is a Chinese e-commerce company. A lot of people are keeping their eye on this stock because the price just keeps on falling and falling. It's a stock I am personally invested in. And so what I'm going to be doing here is doing a brief, explanation of what this company is, going over their price history, and then basically looking at the bullish perspective on the stock as to why you would possibly be investing in it, and also the bearish perspective as to why people are staying away from this stock and saying, I want nothing to do with it. So first of all, I am a shareholder of JD.com, but the thing is, and this is something I said exactly to the viewers over in Stock Radar, is that I knew going into this that I was probably going to be down in the short term. So I ended up buying 95 shares at $31.47 per share. It was an investment of around $3,000. Now, the reason why I only invested $3,000 is because I'm looking to build up roughly a $10,000 investment in JD.com over the course of the next 6 months. And so I knew that I would probably need to average down to lower my cost basis, so I didn't go all in at once. I would not invest $10,000 basically going all in, because that removes your ability to average down and lower your cost basis. So JD.com is 100% a falling knife at this point in time. They keep hitting new 52-week lows. It is very similar to another investment of mine, GE, which was also a falling knife. But this is exactly what happens when you're investing in companies that are going down, that are basically hitting 52-week lows. This is one of my favorite times to invest in companies. I would much rather invest in a company hitting a 52-week low, not a 52-week high. That's just my personal preference. But one of the risks that you run is that you could be catching a falling knife and you could end up down 15, 20, 25% on that stock in the short term. And you have to have the ability to see the long-term perspective or the long-term outlook and not get shaken out of your position early. But the one thing I will say is, if you are going to be investing in a stock that is at or nearing a 52-week low, you should basically take a small initial position in that stock and then average down and accumulate a meaningful position over a long period of time, because odds are that price is going to continue to fall. Okay, but first of all, let's go ahead and cover a brief history here of JD.com and what has happened with this stock. So JD.com went public back in May of 2014 at an IPO price of $19 per share. So by June of 2015, this stock was trading at a high of about $37.95 per share. So early investors had a nice return there from this stock. Now, after that point, from June 2015 to 1 year later in June of 2016, this stock went from $37.95 a share down to about $20 per share, just about $1 over that IPO price, meaning that basically anybody who had invested in that stock and held it for those 2 years, that obliterated all of their returns and they were back at a break even. And this is not a stock that's paying any kind of dividends to shareholders or anything like that. So basically that was dead money for those 2 years for early investors in JD.com. After that, the stock went on a tear. From June of 2016 to January of 2018, this stock went from $20.13 per share to $50.68 a share in January of 2018. And then in January of 2018, that is when this trade war fear began to enter the market. That is when we began to enter this Chinese bear market. And now, as of September 26th, this stock trades at about $25 per share. So this stock is down 50% from what it was back in January of 2018. And it's about $6 over that initial IPO price from multiple years ago. So this stock is trading at a very low price compared to its price history. But again, that is not in and of itself a reason to be investing in this stock. Anyways, let's go ahead now and cover a little bit more of a background about what JD.com is and the business they're involved with. So this is the second largest e-commerce company in China behind Alibaba. Alibaba being another company I am invested in. I'm very bullish on e-commerce as a whole, and I feel that these Chinese e-commerce companies are trading at a much more reasonable valuation than American companies like Amazon. I would much rather have my money in Alibaba and JD.com than to have it in Amazon at this point in time, but that is just my personal preference. So JD sells goods directly to customers just like Amazon. A lot of people have misstated and said that Alibaba is the Chinese Amazon, and this really is not correct. There's a big difference here between what Alibaba is doing and what JD.com is doing, and this really comes down to two things: the logistics and the fulfillment. So basically, if I were to make a comparison here, Alibaba is more like the Chinese eBay. They are a platform where people can go on there and sell their goods, but those people are going to be shipping those goods to their customers. Whereas JD.com is what I would really call the Chinese Amazon, but they're a little bit different than Amazon too, because they're actually the courier as well. They deliver most of the packages that they are shipping. So not only are they fulfilling that, not only are they, packaging the goods, they also handle the logistics and deliver them to the customers. And that is one of the main differences here between the United States and China, is that in the United States we have major courier services. We have the UPS, US Postal Service, we have FedEx, but in China there are no major courier services, and so this is why JD made this decision to not only fulfill orders and handle also the logistics as well and the delivery of those packages. So basically, in a nutshell here, JD.com sells goods directly to consumers like Amazon. JD owns both the fulfillment network and the logistics network, and they are delivering most of their packages. Whereas Alibaba is more or less just a fulfillment network. They're never touching the products. JD.com, they're touching the products, they're fulfilling the orders. Alibaba doesn't touch any products, and that is the key difference between these two companies. So that is why I would call JD the Chinese Amazon, and I would call Alibaba the Chinese eBay, and that's why I'm invested in both of these stocks. A lot of people would say, well, why are you investing in two companies that are in direct competition with each other? I don't believe they are. We have room for both eBay and Amazon here in the United States, and both of these companies are doing very well. I believe there is also room for both a JD.com and an Alibaba in China. So as a result of these differing business models, JD has an expensive business model. It's very expensive to have the fulfillment network and the logistics network and all these trucks out delivering packages. But as a result, they have better quality control and they have lower margins. They have much better quality control over these products because they're actually touching them, actually shipping them to customers. Now, Alibaba, on the other hand, they have a very inexpensive business. They're not actually touching any packages. As a result, it is a marketplace similar to eBay. The quality control is lower, but the margins are significantly higher. So a lot of people incorrectly compare the margins of JD.com to Alibaba, and they don't understand the major differences between these two businesses. That's the same as comparing the margins of eBay to the margins of Amazon. They are two completely different business models. Okay, so that's a bit of a background there on JD.com. Now I'm going to start with the bullish thesis on this stock and why I am personally invested in JD.com. And number one, the first reason is because of the strategic partnerships or the investments from some of these large companies. There's a lot of huge companies out there that are either partnering up with JD.com or investing in JD.com. This could be a very long video if we wanted it to be, but if you guys are interested, just look this up. Look up what the actual partnership agreements or the investments are. But JD.com has either a partnership with or investments from Google, from Baidu, from Walmart, from Tencent, and then another Chinese company, IQIYI. Not 100% sure on the pronunciation, but it's another stock that a lot of people are talking about these days and a lot of people are interested in. But they have some very, very crucial partnerships with some very large companies, and there are a lot of very reputable companies that are either partnering with JD.com or they're investing in this company. Number two, this company is still seeing explosive growth. In the most recent quarterly earnings report, they showed net revenue growth of 31.2% quarter over quarter and annual active customer accounts growth of 21.5% quarter over quarter. So this is still an explosive growth stock, but this is not being reflected in the share price. I always look to see a deviation here where the company is performing very well. They're seeing explosive growth, but that is actually not being reflected in the share price. That is when you can unearth hidden value in the market. And as of what's going on right now, this is a stock that's being dragged down by the overall market and this bear market we're seeing in China. And then number three, my third reason for investing in this company is because of this low valuation. Like I said, I would much rather have my money in one of these Chinese e-commerce companies like Alibaba or JD than I would in Amazon. And I was an Amazon shareholder in the past. But I just want to show you guys here a bit of a comparison between the valuation of JD and the valuation of Amazon. And it's not as simple as looking at a PE ratio, because this is not a company that I believe is even profitable at this point in time because of all the capital investment required to basically get this business off the ground in terms of the fulfillment and the logistics networks and all of that investment. But in 2017, JD did $55.7 billion of revenue, while Amazon did $177.9 billion in revenue. So it's really unbelievable to me to see that, JD.com did roughly, about a third of what Amazon did in 2017 in terms of revenue when you compare the difference in the valuation of these two companies. So JD.com has a market capitalization currently of $36.3 billion, which means they are trading at 0.65 times their 2017 revenue. Amazon, on the other hand, is trading at a market capitalization of $969 billion, or a valuation of 5.4 times their 2017 revenue. That right there is my main reason for being invested in, a Chinese e-commerce company over Amazon. And guys, there are so many other reasons to be bullish over JD.com. There's a lot of exciting things they are doing, and they are very similar to Amazon with their business model, with offering, something very similar to Amazon Prime. They're exploring drone delivery. They're, including automation in their whole process and trying to leverage technology. So I really recommend, if this is a company that's on your radar, do some research on these strategic partnerships with, Google, Baidu, Walmart, and understand what it is that's really going on with this company. But anyways, now I want to move over and talk about the bearish thesis here, why you would say I'm not going to touch this stock with a 10-foot pole. And number one on this list has to be bad management. The CEO, Richard Liu, was just recently in the news in September over some kind of sexual misconduct scandal. He was arrested while he was here in the United States, and the stock took a major plummet just on that news. And unfortunately, this is not the first time there have been headlines involving this CEO and something related to this kind of nonsense going on. And so when you have a CEO who's a loose cannon, this can be a major hiccup with this stock here. He could go out there and do something stupid. He could get arrested again. And that right there is a major mark against this stock, in my opinion, is that the CEO is a bit of a loose cannon based on what has happened in the past and recently here as of just September. Another reason that a lot of people are bearish and not interested in Chinese stocks overall or JD.com is the fact that we are in a Chinese bear market right now. We have seen a massive correction take place with these Chinese stocks, and this is primarily due to the trade tensions between the United States and China. And there is no real sign right now of anything getting resolved at this point in time. And so a lot of people are saying, we don't know what's going to happen. We have no idea what is going to happen with these companies in terms of tariffs and what's going to go on with this. So we want nothing to do with it. And frankly, I don't blame you, because all we're going to be seeing until this is resolved is just immense amounts of volatility and confusion. And like I said, if you guys are not experienced with investing, if you're not comfortable with this volatility, if you're not comfortable buying a stock, seeing it go down 10, 15, 20% and averaging down and accumulating a position over time, then this probably isn't a stock that should be on your radar. But if you are interested in building a meaningful position and taking advantage of this sale here in Chinese stocks, then this might be a stock that you could put on your radar and keep track of. But for that reason, because of the trade tensions between US and China, a lot of people have sold out of their Chinese stocks and they want nothing to do with them. And then third and finally, the biggest argument that I hear against JD.com is that Alibaba is going to beat them by having better margins and lower operating expenses. But again, this is mostly from people who don't understand the differences between the business model of Alibaba and JD.com. And I believe there's room for both of these companies, just as we have eBay and Amazon here in the United States. And when you compare the margins of Alibaba to JD.com, it doesn't make sense. It's comparing two companies that have completely different business models. And just to give you guys an example of this, in 2017, eBay had operating margins of 24%. Those are fantastic margins because it's a very lean business. As far as I know, eBay's not touching any packages themselves. It's third-party sellers who go on eBay's platform and they sell through that platform, and eBay takes a cut or a commission on that sale. They're not actually, touching any of these packages or items. So that is a great business because it's super lean and the margins are going to be higher. Amazon, on the other hand, in 2017 had an operating margin of 2%. Compared to a 24% margin from eBay. So it's not really fair to compare the margins of Alibaba to JD. It would be similar to trying to compare the margins of an eBay to an Amazon. They're just drastically different companies. And as I've said, I believe there is room for both of these companies. But anyways, guys, that is my opinion on JD.com. Like I said, I am a shareholder in this company. I'm looking to build up a position of around $10,000 over the next 6 months. But again, if you are interested in this stock, make sure you do more research, understand what this company is involved with, what they're doing, and you always want to make sure you're doing more research above and beyond what you see in YouTube videos. That is just common sense. But anyways, guys, thank you for watching this video. I hope you enjoyed it. I'd love to hear your thoughts about JD, Alibaba, any of these companies mentioned down in the description below. But thank you for watching, and I will see you in the next video.